Have you ever wondered why you make financial decisions that don't always make sense? Why you hold on to a losing investment? Or why you feel the urge to follow the crowd, even when it doesn't seem logical? The answer lies in something called behavioral finance biases. These are mental blocks and emotional triggers that influence how we handle money, often in ways that cost us dearly. In this video, we'll explore the top 5 behavioral finance biases that could be draining your wallet right now. By the end, you'll not only understand these biases, but also learn how to avoid them. Let's dive in. Our first bias is loss aversion. This is the tendency to fear losses more than we value gains. In fact, studies show that the pain of losing $100 is about twice as powerful as the pleasure of gaining the same amount. Here's an example. Imagine you're holding a stock that's dropped 20% in value. Instead of cutting your losses and reinvesting in a better opportunity, you hold on to it, hoping it will bounce back. Why? Because the idea of locking in that loss feels unbearable. But here's the problem. Loss aversion can lead to poor investment decisions. You might hold on to underperforming assets for too long, missing out on better opportunities. Or you might avoid taking necessary risks that could lead to significant gains. Let's take a real-world example. During the 2008 financial crisis, many investors held on to plummeting stocks, hoping for a rebound. Instead of cutting their losses, they watched their portfolios shrink further. Those who recognized their loss aversion, took their losses, and adjusted their investments early on were able to recover much faster. So, how can you combat loss aversion? Start by reframing your mindset. Focus on the long-term potential of your decisions rather than short-term losses. And remember, sometimes cutting your losses is the smartest move you can make. Another strategy is to set predefined rules for your investments. For example, decide in advance that you'll sell a stock if it drops by a certain percentage. This removes the emotional component and helps you stick to a rational plan. Finally, consider the bigger picture. Ask yourself, if I weren't already invested in this, would I buy it today? If the answer is no, it might be time to let go. Next up is confirmation bias. This is our tendency to seek out information that confirms what we already believe, while ignoring evidence that contradicts it. Let's say you're convinced that a particular stock is going to skyrocket. You might only pay attention to positive news about the company, while dismissing any red flags. This can lead to overconfidence and poor decision-making. Confirmation bias is especially dangerous in investing. It can cause you to overlook warning signs, take on too much risk, or double down on a bad bet. Take the example of the dot-com bubble in the late 1990s. Many investors were convinced that internet companies were the future, and they ignored traditional valuation metrics. They only paid attention to analysts and news outlets that supported their bullish views. When the bubble burst, billions of dollars were lost. To avoid this bias, make a conscious effort to seek out diverse perspectives, challenge your assumptions, and don't be afraid to play devil's advocate with your own ideas. A well-rounded view can save you from costly mistakes. One practical tip is to create a checklist of pros and cons before making any investment. Force yourself to consider at least 3 reasons why your decision might be wrong. This simple exercise can help you see the full picture and make more balanced choices. Another strategy is to consult with people who have different viewpoints. Whether it's a financial advisor, a mentor, or even a friend, getting an outside perspective can help you identify blind spots you might have missed. Our third bias is anchoring. This is when we rely too heavily on the first piece of information we receive, often called the anchor, when making decisions. Imagine you're shopping for a new car. The salesperson starts by showing you a high-priced model. Suddenly, every other car seems like a bargain, even if it's still over your budget. That initial price has anchored your perception of value. In finance, anchoring can lead to poor investment choices. You might hold on to a stock because you're anchored to the price you originally paid, even if the fundamentals have changed. Or you might overvalue a piece of real estate because of its initial listing price. A classic example of anchoring is the housing market. During the 2006 housing bubble, many buyers anchored their expectations to the inflated prices they saw at the peak. When the market crashed, they were left with properties worth far less than what they paid. To break free from anchoring, focus on objective data. Ask yourself, is this decision based on current facts, or am I being influenced by an arbitrary starting point? By staying grounded in reality, you can make smarter financial choices. One way to combat anchoring is to use a valuation framework. For stocks, this might mean looking at price-to-earnings ratios or discounted cash flow models. For real estate, it could involve comparing similar properties in the area. By relying on data rather than emotions, you can avoid being swayed by irrelevant anchors. Another tip is to delay your decision. Give yourself time to process new information and reassess your initial assumptions. Sometimes, stepping away from a decision can help you see it more clearly. Now let's talk about overconfidence. This is the tendency to overestimate our knowledge, skills, or ability to predict outcomes. Think about it. How many times have you been absolutely sure about an investment only to watch it tank? Or how often have you assumed you could time the market, only to miss out on gains? Overconfidence can lead to excessive trading, taking on too much risk, or failing to diversify your portfolio. And here's the kicker. The more confident we are, the less likely we are to double-check our decisions. A famous example of overconfidence is the collapse of long-term capital management in the late 1990s. The hedge fund was run by Nobel Prize-winning economists who were convinced their models were foolproof. They took on enormous risks, assuming they could predict market movements. When their bets went wrong, they nearly caused a global financial crisis. So, how can you avoid overconfidence? Start by acknowledging that no one, not even the experts, can predict the future with certainty. Diversify your investments, stick to a long-term strategy, and always be open to learning. A little humility can go a long way in protecting your finances. One practical tip is to track your investment decisions and their outcomes. Keep a journal where you record why you made a particular choice and what the result was. Over time, this can help you identify patterns and recognize when overconfidence might be clouding your judgment. Another strategy is to set limits on your trading activity. For example, decide that you'll only make a certain number of trades per month. This can help you avoid impulsive decisions and stay focused on your long-term goals. Finally, we have herd mentality. This is the tendency to follow the crowd, even when it doesn't make sense. We've all seen this in action. Think about the dot-com bubble, the housing market crash, or the recent frenzy around meme stocks, AI, and crypto. People rush in because everyone else is doing it, often without fully understanding the risks. Herd mentality is driven by fear of missing out, or FOMO. But here's the truth. Just because everyone else is doing something doesn't mean it's the right move for you. A recent example is the GameStop stock frenzy in early 2021. Retail investors, encouraged by social media, drove the stock price to astronomical levels. Many jumped in simply because they didn't want to miss out, only to suffer significant losses when the bubble burst. To avoid this bias, take a step back and think independently. Ask yourself, am I making this decision because it's smart, or because I'm afraid of being left out? Remember, the crowd isn't always right, and sometimes the best opportunities are found by going against the grain. One way to combat herd mentality is to do your own research. Don't rely solely on what others are saying or doing. Take the time to understand the fundamentals of an investment before committing your money. Another tip is to set clear investment criteria. Decide in advance what types of investments align with your goals and risk tolerance. This can help you stay focused and avoid being swayed by the latest trends. So there you have it. The top 5 behavioral finance biases that could be costing you money. From loss aversion to herd mentality, these mental shortcuts can lead to costly mistakes. But the good news is, you can overcome them. Here are a few practical tips to help you stay on track. 1. Educate yourself. The more you know about these biases, the easier it is to spot them in your own behavior. 2. Slow down. Take your time with financial decisions and avoid acting on impulse. 3. Seek advice. A trusted financial advisor or mentor can provide an objective perspective. Stay disciplined. Stick to a long-term plan and don't let emotions derail your progress. By understanding and addressing these biases, you can make smarter financial decisions and take control of your future. Thanks for watching, and don't forget to like, share, and subscribe for more tips on mastering your money. See you in the next video.